Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. The government withdrew the Personal Data Protection Bill 2019 from the Parliament on Wednesday, while promising to come back with a new draft. It comes after a joint parliamentary committee, which sat over the bill for over 2 years, suggested staggering 81 amendments to it in its 542-page report. On its part, opposition Congress claimed that big tech companies would be happy with this move. So, in our next report, we ask why India is still waiting for a data protection law and how does this delay affect both consumers and businesses.
According to Dutch cybersecurity firm Surfshark VPN, India had the second highest number of data breaches in the first half of 2022. And on Friday, a Ukrainian cybersecurity researcher claimed that sensitive personal data of 280 million Indian citizens allegedly from the Employees Provident Fund Organization database surfaced online. Each record allegedly included personal information like full name, nominee details, marital status, address, bank account numbers, Aadhaar details, income levels, etc. India currently lacks a sound legislation for data protection. After 5 years in the making, the bill that was designed to protect the privacy of Indians, the Personal Data Protection Bill 2019, was withdrawn by the government on Wednesday. The government is sure to table a new bill soon. A committee led by former Supreme Court Justice B.N. Sri Krishna, constituted in August 2017, submitted the draft PDP Bill 2018 the following year. On December 11, 2019, the Ministry of Electronics and Information Technology tabled the PDP Bill 2019 in Lok Sabha. That same day, it was referred to a joint parliamentary committee, which tabled its report 2 years later, on December 16, 2021. IT Minister Ashwini Vaishnav said the bill was withdrawn because the panel suggested 81 amendments and 12 major recommendations. The bill had alarmed big technology companies like Meta and Google, who feared it could increase their compliance burden, data storage requirements, and restrict cross-border flow of data. As the bill provided large exemptions to government departments, several privacy advocates said it would allow agencies to abuse access to data. The parliamentary panel also said that non-personal data should be included in the purview of the bill, which originally focused only on individual privacy, in tune with the 2017 Supreme Court verdict that held right to privacy as a fundamental right.
The move to withdraw has left many of us perplexed. The efforts to bring about a data protection framework in India started somewhere in 2011, the Personal Data Protection Bill. That dates back to 2017. We finally get the JPC report and along with it, the draft. There is no denying that the bill was imperfect. But the question is, was it the imperfections that motivated the government to withdraw the bill? And if so, to what extent is it justified? The ministry has voiced that it would rather bring out a delayed bill that can adequately address the rapidly evolving technological landscapes in India than rush an inadequate one. The 2021 DPB bill has been a result of almost 4 years of deliberation, several inputs and comments provided by stakeholders, a committee that published a report almost after 78 sittings, and which also included dissent notes. So all of this labor and effort, which should have ideally taken us forward, has somehow brought us back to square one. The fears of the government that bringing an imperfect bill could lead to bad privacy practices being adopted. But we also have to remember that we have a very strong institutional mechanisms for checks and balances. We have judicial oversight. We have parliamentary amendments. We have debates in the parliament. There can be a very transparent and open conversation around this.
The delay has consequences for Indian consumers and companies alike.
Unfortunately, since there is no obligation on companies with regard to data protection as such, and there are no procedures laid down, there are no regulatory requirements, there is no penalties. So they are the ultimate sufferers. Their data is being stolen, sold, and breaches are happening almost day in, day out. My understanding is that the government initially wanted to just cover personal data. Then subsequently, they wanted to bring non-personal data also within the ambit of the proposed legislation. I think now they realize that they could not bring in a piecemeal legislation which would be hurriedly pushed with some basic provisions with recovering non-personal data, because the government has very long-term plans in terms of trying to use that as a community resource and monetize it as a national resource. So in my opinion, I think the government is now going to bring two separate bills, one to cover personal data and the other to cover non-personal data. We never know, it could take another 2-3 years for the bill to get passed. There is no timeline that has been provided by the government. The other aspect is the international aspect, because IT industry, the call center industry, the back office services industries, these sectors are completely dependent on international perception. India for almost 10-15 years has been negotiating to get a data safe country status from the EU. We are moving towards a situation where almost all countries have their own laws and they are following the EU GDPR model, and the requirements in each of these jurisdictions obligate that either our companies directly comply with their legislations if they're providing services to their customers, or India has a equally robust privacy legislation. Overall, in that sense, industry loses both in terms of the compliance costs, in terms of the general perception internationally, also in terms of the ambiguity which still remains after all these years.
The government says it is working on a comprehensive legal framework after considering the parliamentary panel's report. Meanwhile, the Internet Freedom Foundation has argued that the existing legal vacuum on data protection is an infringement of the fundamental right to privacy. Whether or not the new bill addresses the existing concerns raised by companies and privacy advocates, the wait for a personal data protection law in India gets longer.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Data, as they say, is indeed the new oil. And apart from other things, it is also fueling the television's growth story. So, as the audience went tech-savvy, our humble TV kept the pace and turned smart. It offered them good content on the big screen and combined it with a couch and a bowl of popcorn. It is a comfort which no other platform matches. Our next report explains how TV managed to stay relevant in this fast-changing world.
So, it has turned out that our humble idiot box is not as dumb as thought. It has kept pace with the changing times. It is bigger, leaner, and equipped with advanced technology now, offering great visual experience. But the challenge is always there. Online audiences have grown faster than any other medium, including television, in the last 3 years, raising questions about the future of TV. However, such arguments can be put to rest as people remain committed to TV. It remains by far the largest video medium in India, with 878 million viewers. That is nearly twice the number watching online videos. With 72,000 crore rupees a year in advertising and pay revenues, television towers over every other outlet, cornering 45% of all media revenues. Even as television languishes on older distribution formats, such as cable and DTH, it is having a concurrent resurrection online, providing half of all videos consumed. Disney Plus Hotstar and Sony Live, both owned by television companies, are among the top 10 video apps in India. While linear television audiences declined marginally last year, It still fuels the growth of online videos in India, on YouTube, short video apps, and all other distribution formats. The rise of the internet as the latest distribution technology for content is also shaping the future of TV.
Who watches TV? 878 million Indians watch TV for 3 hours and 50 minutes each. That's almost twice the number that watches online video or streaming video. So when we talk about the future of television, we are essentially talking about the decline of the distribution formats that used to carry TV signals to us. TV by itself remains robust and strong because 50% of what is watched online on pay OTT, on YouTube, on MX Player, or on any app is TV content. It will be your Kumkum Bhagya, IPL, sports, all of these are watched online. There is, when we talk about the future of television, remember, this is about the decline of the formats that distribute television and the resurrection or the dominance of these new formats by existing television companies in addition to the new players coming on online. That's what the future of television is all about. Its set of competitors now changes from the earlier ones.
More than half of what India watches continues to be on general entertainment channels, with 5 non-Hindi channels in the top 10. Hindi, Tamil, Telugu, and Kannada remain the blockbuster languages of television, showing year-on-year growth. The simplicity of its model keeps television going, as choices across the video spectrum multiply from 10-second videos to 10 hours of binging. But the single biggest trend right now is the migration of viewers at the top end to pay OTT and at the bottom end to free-to-air television and free OTT. It means the decline of television on older distribution formats, such as cable and DTH, and its concurrent resurrection online.
If you look at some of the compelling broadcaster OTTs, whether it is Hotstar or it is a Sony Live or a Z5, close to 65-70% of their consumption comes from the catch-up TV content, wherein people really want to watch their content as per their convenience. And also there's this option of, watching it without advertisement. In terms of the path going ahead, I think there will always be this differentiation between TV content and digital content. So OTT as a phenomena in a country like India was just started about 6 to 7 years back. I think 5 years down the line, the TV catch-up consumption content or the share of TV content will only keep on dwindling. What works in India OTT platforms today, it is either web series or movies or TV shows. Once these number of web series scale up, once more seasons come in, once more OTT platforms launch more franchise web series, you will see the TV content share coming down on OTT platforms. TV as a medium is going to coexist in India, but the larger portion of incremental growth will happen by digital. So definitely there's one point here that digital will overtake TV in terms of ad share. There is no doubt about it. Even on the payment mechanism side, if you see TV is very large, we've got really low ARPUs of 300 rupees monthly. And that's the reason, if you look at the TV industry numbers, 60% of the numbers are coming from pay-based revenue, which really goes to show that, India as a country is very friendly as far as payment for TV is concerned. But if you look at for the payment for OTTs, the numbers are very low. ARPU numbers or digital are still very low as compared to TV. So a lot of catch-up has to be done there. So basically that's the reason, digital growth rate in terms of ARPU will be much more faster as compared to TV, whose ARPU growth rate will more or less be stable.
The OTT market in India is still nascent. As streaming companies add more originals to their library, the viewing share of TV content will come down. But the growth of TV depends on its ability to migrate its audiences and business online, irrespective of the technology that transmits the content. The future hinges on the internet, and television seems to be riding that for now.
यार
मत पूछ यार,
फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Large LED or Ultra HD TVs have also become a status symbol, slowly pushing bookshelves out of living rooms. Meanwhile, the prices of Brent crude oil, which had gone through the roof, are coming down. On Wednesday, OPEC Plus decided to hike output by 100,000 barrels per day. After that, Brent slipped nearly 4% to below $100 a barrel mark for the first time since 11th April. Are they headed lower in the days to come? Let us find out in our next report.
Oil prices have slipped below $100 a barrel in the past couple of days. Weighing on crude price is the US Energy Information Administration's weekly inventory report, which suggested an unexpected increase in US crude oil stocks and drop in gasoline demand despite ongoing summer driving season in the US. While global central banks, especially the US Federal Reserve, has hiked rates to tame inflation and kill demand, OPEC Plus has decided to raise its oil output goal by 1 lakh barrels per day starting September. The increase is equivalent to 0.1% of global demand. It follows weeks of speculation that Biden's trip to the Middle East and Washington's clearance of missile defense system sales to Riyadh and the United Arab Emirates will bring more oil to the whole market. Notably, the increase of 1 lakh BPD will be one of the smallest since OPEC quotas were introduced in 1982. Ravindra Rao of Kotak Securities, for instance, expects prices to slip further in the immediate short term. Crude has hit fresh lows, which indicates weaker sentiment. However, supply concerns may keep a floor to price close to $90 per BBL level. Brent prices have been volatile thus far in 2022 as the oil market reacted to the geopolitical developments amid recession fears. Paul Hicken of S&P Global Commodity Insights expects the Brent oil to climb and remain in a range of $100 to $120 a barrel in the medium term.
The OPEC Plus agreement provides a symbolic nod to the US, but at the same time acknowledges the tight fundamentals that are occurring in the oil market still. OPEC Plus spare capacity is at historic lows of not much more than 1 million barrels a day, mostly in the hands of Saudi Arabia and the UAE. And you still have a situation where there are key risks for OPEC Plus. There's a demand side situation which is already shown signs of weakening, given the fears around recession in the US and Europe. China demand remains weak, and at the same time, on the supply side, Russian supply remains relatively strong and hasn't come off in the same way, and that's a potential risk going forward, as is US hurricane season in September. So as a result, OPEC Plus wants to keep a little bit of the powder dry for those risks, and as a result, the oil market is probably going to stay in the $100 barrel plus region for some time.
On Friday, all eyes will be on the outcome of the Reserve Bank of India's meeting on interest rates. Analysts expect the Indian Central Bank to hike repo rate between 35 to 50 basis points. That apart, stock-specific action will continue amid the ongoing results season.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Gains made on the sale of equity shares are taxable. The percentage of tax that you pay depends on how long you kept the shares. In our next report, we talk about these taxes and also if you can offset the losses against the gain while filing the tax returns. Let's watch it.
Any income or loss that is made from sale of equity shares is covered under the head Capital Gains. Income under this head is further classified into long-term capital gains and short-term capital gains based on the holding period of the shares. Holding period takes into account the duration for which the investment is held, beginning from the date of acquisition to the date of sale or transfer. For income tax purposes, the holding periods for listed equity shares and equity mutual funds are different from that of other asset classes. If equity shares listed on a stock exchange are sold within a year of purchase, the seller may make short-term capital gain or incur a short-term capital loss. The seller makes short-term capital gain when shares are sold at a price higher than the purchase price. Short-term capital gains are taxable at 15%, irrespective of the tax slab the investor falls under. Any short-term capital loss from sale of equity shares can be offset against short-term or long-term capital gain from any capital asset. If the loss is not set off entirely, it can be carried forward for 8 years and adjusted against any short-term or long-term capital gains made during these 8 years. A taxpayer will only be allowed to carry forward losses if he has filed his income tax return within the due date. If equity shares listed on a stock exchange are sold after 12 months of purchase, the seller may make a long-term capital gain or incur a long-term capital loss. Until March 31st, 2018, long-term capital gain made on the sale of equity shares or equity-oriented units of mutual funds was exempt from tax. But the rules changed from April 1st, 2018. Now, if a seller makes a long-term capital gain of more than 1 lakh rupees on the sale of equity shares or equity-oriented units of a mutual fund, the gain made will attract a long-term capital gains tax of 10% plus applicable cess. Also, the benefit of indexation will not be available to the seller. Any long-term capital loss from a transfer made on or after 1st April 2018 will be allowed to be set off and carried forward according to the existing provisions of the Income Tax Act. So, the long-term capital loss can be set off against any other long-term capital gain. Such loss can also be carried forward for subsequent 8 years.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The government also introduced grandfathering clauses to ensure that the tax is only prospective in nature. So, the tax will be levied only on the gains from the date of levy of such tax. That is all for today. We will be back with more news and analysis on the next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.